All right, I'm Michael Hartzman, and today's Tuesday, October 14th, 2025. And tonight, Tracy Burns, who normally the last couple of times has sat in for me, is tonight sitting in for Dominic. So, Tracy, you and I haven't done a show together. So, welcome to the Lebenthal Report.
Thank you, Michael. I'm super excited.
And just to remind our clients, you joined us about 6 months ago, and you are director of women in investing. If I remember correct, am I remembering that correctly?
Dom actually dubbed me vice president of women in investing, but either works.
Exactly.
Handing out
Well,
titles, handing out
exactly.
titles left and right.
Whatever it is, we're happy to have you, and I'm happy to have you co-hosting with us.
Thank you.
And look, we're just going to do what I normally do with Dominic. We're going to go over the numbers the past week and just do a quick update. And Dom's probably happy he's not here because last week was pretty ugly. The market took some money off the table finally, with the S&P down about 2.5, the Dow down about 2.7, and the Nasdaq down about 2.5. And it's funny that these indices have been running kind of in concert the last couple of weeks. And Friday was particularly, I think it was Friday, where Trump announced, kind of out of the clear blue sky, that he was going to put some unilateral, harsh tariffs on China. He backed off a little bit on Monday, but the market, I think, did take a 700-point hit from Trump on Friday, which contributed to a lot of the sell-off we saw last week.
Then he sent the tweet out on Sunday and sort of said, well, I didn't really mean it. It's going to be fine. All is well. Kevin Bacon from Animal House kind of thing. And then we've since come back. I wonder your thoughts, though, Michael, on one, we've known that China was going to be an issue for us, right? We knew this was not going to be easy. China, we need China, they need us, but China's not backing down anytime soon. They don't care about their people. They don't care about anything except world domination, right?
Right.
So we knew this was coming. We knew it was going to be tough, and yet the market sells off. Do you think it was just the market looking for an opportunity to create a buying opportunity?
That's exactly what I think. I think if the market was just kind of meandering along or was already, experienced a sell-off, I think that would have been good old-fashioned headline risk. But because the market really mostly driven by AI and that story, which we'll get into in a second, I think, Tracy, the market was just looking for a reason, as you said, especially on a Friday, just to take some profits and go hide for a bit.
Yeah, I think so too. I always worry about the wealth effect, though, right? Like when people see their accounts go up, they feel rich, they go spend money. The second they come down, they're like, uh-oh, I can't afford that anymore. So you worry about the emotional side to what he just did with that China thing. But that said, as long as the market slowly grinds itself back up, I think the consumer comes back and does what it's been doing, which is shopping.
Exactly. And don't forget, they just got their quarterly statements and they got their quarterly 401k statements. So I think the halo of the wealth effect was still alive and well based on what they experienced the quarter before.
Yeah, I absolutely agree with you. And there's still, I mean, what do they say? Oh, $7.4 trillion on the sidelines in money markets. Like, so when do we see that start to come back? When do people start to say, okay, the interest rate's going down on this money market. I really should start dabbling in other things.
I think we've seen that a little bit because the bond market, which has been a frustration for most financial advisors, has really begun to do well. And I think, as you and I were talking about a client this morning about their CDs, I think as CD rates, you don't look as attractive when they start to come off the table and they have to renew. So I agree with you. I think over the next 6 months, a lot of that $7 trillion starts to come off the table and it's got to go someplace.
Yeah, 100%. And then we've got earnings starting up this week, right? And God bless the banks. They always come out of the gate on fire. And I think that sort of renews everyone's faith in the system again after what was a little bit of a bumpy weekend.
Yeah, and then I want to talk a little bit about the whole artificial intelligence, AI, data center, energy story. You and me and a couple of our team were at BlackRock's headquarters 2 weeks ago, and then last week Dom and I were invited to the ETF, JP Morgan ETF Summit in Manhattan. There were about 100 advisors there from around the world. Jamie Dimon was the keynote speaker, and they might as well have renamed it the AI Summit because it was the underlying theme of the conference. And I think it was at last week's meeting, they said something which kind of put this whole AI boom into context, comparing it to 2001. And why is it different this time? Why is this technology surge different than 2001? And every time you and I or a financial advisor says it's different this time, it always bites us in the backside. But what they said was in 2001, the technology bubble was built upon debt.
Yes.
That money was rushing into this sector. And this time, these huge AI infrastructure build outs by either Amazon or Google or Apple, Tracy, they're being financed by revenue.
Right.
And
right.
And I go, oh, well, that makes perfect sense, right? These are huge companies that are building out their own infrastructure. They're not going to the public market, trying to raise money with the hope that, they're going to be able to monetize this.
I was a journalist back during the dot-com bubble, and I remember reading financial statements for, the Globe, Pets.com, and there were no financial statements, Michael, right? I wasn't reading numbers, and if I was, they were red. And so that's why this does feel different to me as well. And I love the point that they're doing it based on revenue versus debt. I guess the only thing, the concern is it's kind of an arms race, right? So, and who's going to win here? And all this money, I mean, you're seeing numbers like $1 trillion being invested, which is crazy. Is everyone going to win? I don't know. I hope so, but I don't know.
And I know for sure you asked the question in the BlackRock meeting about how long is it going to take these companies to actually monetize it, right? I mean, they're pouring in, I didn't know it was trillions, I thought it was billions, but whatever it is, it's a ton of money. And you asked the question to one of the analysts, or maybe even asked Rick Reeder, I don't remember, when are they going to monetize this? When are they going to make money?
Right. Because all they were talking about, at least at the BlackRock event, was they're taking over our jobs. They're taking over everything. I'm not sure what we're going. And actually, I remember one of them saying that Rick Reeder said he liked the hospitality sector because people are going to have more time on their hands because they're not going to have jobs because of AI. So that's the part I think that's scary to me. This notion that someone said 3 to 4 million jobs will be lost. What are we replacing them with? Or, are we educating our kids to be in the space properly? So that whole transition, I think, is happening way faster than it did in the 90s.
100% agree. And to that note, Dominic and I did do our show last week, and we had an author who discussed the whole artificial intelligence boom, and he did a very good job. He was a doctorate student, PhD student up in Canada, and he did a great job in putting this all into context. And to me, it reminds me a little bit, although we both were not alive, during the Industrial Revolution, where yes, the blacksmith was replaced, right? The printing press was replaced, but they were replaced by other jobs. So I love Rick. He's one of the smartest people I get to talk to, but I don't know if all 3 or 4 million people are going to go on vacation. But there is going to be some new training involved. I totally agree with that.
Oh yeah, and I think sadly, the education system doesn't turn nearly as fast as the economy in the world does. And so here we are again, semi behind the 8 ball with our kids. I mean, why we're teaching about Mesopotamia in 3rd grade still, I don't get, because we're not training our kids to be agile in this upcoming, innovative stages.
Well, I'm going to agree with you to a certain degree because I do have younger grandchildren. And when my granddaughter was 2, I mean, she would go on YouTube and she knew exactly where the skip ad little button was. And she knew exactly how to use it. She's going through her YouTube videos. So I think that the difference, Tracy, is for younger people, it's a second nature.
Yes, very true. Very true. But we also have to figure out, my daughter's a senior in college, and I say to her, you're so lucky you're almost done, because AI, the kids are starting to use it. They have to figure out a way to block AI in the classroom. Are they going to go back to blue books and pencils? I mean, that's what I use. That's how I took my college exams, right? So how are they going to do that? There's so many changes that are happening that I said, you're lucky, because it's also going to hurt the kids coming out of college looking for those first time jobs, because that level is probably where AI is going to hit the fastest and hardest.
You're right. And the other thing I think that we don't talk about it enough is you students are going to learn how to write. Someone else is writing for them. So a good friend of mine owns several newspapers, and I frequently contribute to those newspapers. And he asked me to write a story about this topic, actually. And I used ChatGPT to do research, but I wrote the article, right? And I felt if I didn't write the article, it was cheating, right? I mean, I had to write the article, but I could have given him a comprehensive article in 45 seconds, right? But to me, I still think it's important that you do your own writing, and you do learn how to use your own brain and put a thought together and put it on paper.
Well, and fact check. It's not all accurate 100% yet either. It definitely makes errors. One of our colleagues, actually, God bless him, we were doing a plan together, and he caught it. So it's not perfect yet.
Yes, I know, and I know the plan you're referring to, and he still
Yes.
insists that ChatGPT was incorrect, and he is correct. He's probably right. So listen, we spent some time talking about our younger population, and not not only old people buy long-term care, but it's certainly a demographic for older Americans. Yes. And it's a topic, quite frankly, that Dom and I have tackled in the past, but not nearly enough, and not recently. So tonight, Tracy, you and I are going to tackle the whole topic of long-term care. And we have our friends at Crump who are happy to get us a guest. And his name is Rick Stewart. He's a regional director of disability and linked benefits and long-term care. And he'll be joining us for the rest of the show. And we'll be back shortly with Rick Stewart, regional director at Crump. All right, I'm Michael Hartzman, back with my co-host tonight, Tracy Burns, also from Lebenthal, who's sitting in for Dominic Tavella tonight, and our guest, Rick Stewart, a regional director at Crump, whose specialty, among other things, is not just long-term care, but we're gonna focus on long-term care tonight. So, Rick, thank you, and thank you, Crump, for making you available for us this evening.
Thanks, Michael. It's a pleasure to be here.
Thank you. So let's just start, as I just said before, kind of 50,000 feet in the air. So there are a lot of misconceptions about long-term care insurance. One topic or one response I get frequently is, I have health insurance, or I have disability insurance through work. I don't need long-term care. And long-term care is neither of those things. It's not health insurance. It's not disability insurance. It's its own animal. It's its own species. with its own set of rules. So let's just start there, Rick. What is long-term care insurance?
Yeah, that's a great question. And a lot of people get them confused with the different types of insurances that are out there. Disability insurance is really paycheck insurance, which, if for whatever reason you're disabled and unable to work, you're going to get a percentage of your paycheck. Health insurance today is really focused on skilled care, right? When something breaks, you need to go to the doctor, you need to go to the hospital. It focuses on that skilled care a doctor provides. Long-term care planning really focuses on custodial care. What happens if, for whatever reason, we're unable to perform some of the basic activities of daily living, like walking around the house, being able to get dressed, being able to bathe ourselves, being able to feed ourselves? If we're ever in a position due to old age, frailty, or maybe an accident, like a car accident or an injury or a fall, we need help with those activities of daily living. Typically, the care falls on our family to take care of us, or we have to pay someone to provide that care. So long-term care insurance is a program designed to help reduce that risk to our family and our financial portfolio if we do ever have to have an extended care event.
You make an interesting point, and so about injuries, right? So my question to you is going to be, who's the ideal candidate? But if it also covers injuries, there's a broad range of people that are qualified for this.
Oh, yeah, absolutely. That's a great point because I had a grandmother that lived to 104 years of age, and everybody thinks long-term care is like when we're in our 90s and we go to a nursing home, which my grandmother did do, and she needed care for a decade. But baby boomers today, we like to skydive, scuba dive, vehicle race, mountain climb. We climb up on our roof, we clean the gutters, we fall off of ladders, we have skiing accidents, and about a quarter of long-term care claims actually end in recovery today. It's I had an accident, I had a fall, I went on claim for 6 months or a year, and then I got better and I went back to work.
So, Rick, just so you know, I decided to cut all the trees down around my house rather than go on the ladder and
Hmm.
clean my gutters. That sounds like a terrible idea. Just kidding. I don't want the tree lovers to get mad at me. I still have trees, but so people frequently, and on the same vein about getting injured and how do you qualify for the benefit, let's talk about those functions of daily living, right?
Mm-hmm.
I mean, to me, I always describe it as think of the things you do in the first 5 minutes you wake up, right? You go to the bathroom, perhaps. You as you said, you have to walk someplace, whether it's to the kitchen for coffee. So let's talk about those ADLs and why are they important and what's the tax benefit to them that makes them so critical in qualifying for this benefit.
Yeah, long-term care insurance policies today, in order to qualify for benefits, your doctor, your primary care physician, has to deem that you're unable to perform at least two of the six activities of daily living, or you have a severe cognitive impairment like Alzheimer's or dementia requiring care. So when you wake up in the morning, you stand up, you walk across the room, that's transferring, you're able to move around freely. You made it to the bathroom, you have continence, control of your bladder and your bowels, you're able to use the toilet or the bathroom. You take your morning shower, that's bathing. You're able to put clothes on and get dressed. You go to the kitchen, you make your breakfast, that's eating. Those are the six basic activities of daily living. And for whatever reason, whether you had a severe car accident, a fall, you had a stroke. I'm dealing with a mother-in-law who had a stroke and has half of her body paralyzed, or you live a long life. If you're unable to perform two of those activities of daily living, a long-term care policy is designed to provide the income to pay someone to provide that care that you need. Because if you don't have a plan, then the plan is going to be your family is going to have to provide that care, or you're going to have to pay someone to provide that care.
So like these sound like old people things, right? But when in theory should you really start thinking about buying a plan? Clearly not when you're 90.
No, you're absolutely right. Most policies today do have insurability and underwriting. So you do have to qualify. Just like life insurance, disability insurance, or other types of policies, the younger you are and you buy these policies, the cheaper the rates are going to be. There's various different types of long-term care insurance plans that are out there. And one of the things younger clients are gravitating to is life insurance with long-term care riders. Because when you're young, you're in your working years, you have children, you have a life insurance need, obviously, to cover the mortgage, protect final expenses, protect your spouse's income, that type of stuff. But there also could be that situation where you have an accident, a fall, or need long-term care in your years. So these types of policies provide both a life insurance death benefit and long-term care protection should you need it.
And getting back to those ADLs, the daily living functions, the other reason I want you to discuss is the tax benefits of these policies, assuming you qualify for the benefit because you cannot meet the criteria. Why is that important?
Yeah, one of the great attributes of long-term care insurance is your long-term care benefits are received income tax free. So with disability insurance, if your company pays for it for you, or if you deduct the disability premiums, your disability benefits are taxable. Long-term care benefits are always going to be received income tax free to pay for your benefits. That's why one of the trends we're seeing is even ultra high net worth clients are some of the biggest purchasers of long-term care insurance because it's a way to buy a policy to get a tax-free stream of income to pay for your care when you need it.
Right. And so to be clear, it's after tax dollars that pay for the plan now so that you get the benefit tax free later on.
That is correct. Now, also, if there are people on the call that are self-employed or own a business, long-term care insurance premiums can be tax deductible. So if you own an S corporation or an LLC, or maybe you're just a sole proprietor running your own business, long-term care insurance premiums can be tax deductible based on your age. And even though you deduct the premiums, your long-term care benefit will still be received tax-free.
I know Tracy alluded it before, but really, Rick, if you look at the demographics of this market, whether they buy a traditional long-term care policy or life insurance with a long-term care rider, and we'll get into the difference in a second. What's the sweet spot in your opinion? Is it a person in their 40s, in their 50s, in their 60s? Where does a financial advisor really need to drill down with a client and say, this is something you should really pay attention to now?
Yeah, I would say age 50 to 60 is really the sweet spot where we're seeing most of the long-term care insurance sales being purchased. But again, younger than 50, there are products today built on like variable universal life chassis, or index universal life products that have growth potential. So we do see younger clients buying those life insurance policies with LTC riders. We also have annuities with LTC riders that for older clients, we can look at long-term care solutions up to age 85. So 50 to 60 is definitely the sweet spot, but anything from 18 to 85, there are insurance solutions out there and available to clients.
You had mentioned when we were talking that November is long-term care month. October is actually National Financial Planning Month, and the two certainly go hand in hand, right? So like as an advisor, we start putting plans together for people. It comes up for sure. And as I mentioned to you, I work with a lot of divorced women because they worry about who's going to take care of them, going forward. What trends are you seeing in the clients that you're selling these to? Is it a lot of single people, young widowers, I should say, or is it young families like you mentioned?
Yeah, I would definitely say we're seeing single female clients is a big market for long-term care solutions, as well as married couples. Especially when there's a discrepancy in age. We know in our life insurance tables that women statistically live longer than men, usually by 3 or 4 years. So couples love to make sure that there's a plan in place. If something, I will always take care of my wife and my wife will always take care of me. But what if one of us is not around to provide care to the other individual? So making sure there is a plan in place that if one of us ever needs care, there's be a way for us to receive that care that we need. Second marriages, as much as divorced female women are a market for long-term care planning, second marriages is a big purchaser of long-term care insurance as well, because a lot of times children, when their parents are on their second or third marriage, aren't going to plan on in their lives taking care of their mother-in-law or their father-in-law. So making sure that there's a plan in place, if you don't want to have to rely on your children to provide your care when you need it.
So let me ask you this, Rick. I frequently will talk to a married couple, and these things, depending on when you buy them, they sometimes they can be expensive, and a working family still does not have the budget for it.
Right.
So frequently, I'll look to the if it's a husband and wife, a male and female couple, I'll look at the female and say, look, I'm going to defer to you if we only could buy one policy, because one or two things are going to happen, and I don't know the answer to it. Either you're going to say to me, my husband is twice as big as me. I cannot lift him. I cannot help him shower. I need to get it for him. Or you're going to say to me, I'm going to outlive him. And even if I don't, he's incapable of taking care of me. So I frequently look at the woman in this situation and say, if you got to pick one, who are you going to pick? And the answer is basically split in half, right? I mean, I would say more often than not, we may buy it for the husband because, they typically, the wife will feel I really, cannot take care of him by myself. But is there a better way to analyze this than me just kind of having the wife flip a coin? No one has a crystal ball.
You're absolutely right. Nobody has a crystal ball. We don't know if we're going to need long-term care services for one day or 20 years. The long-term care industry has seen long-term care claims last over 20 years. The largest long-term care claim is over $3 million and counting on an insurance policy. So where are we going to fall? Everybody likes to default to the averages. Oh, the average person needs care for 2.5, 3 years, but the average person with Alzheimer's needs care for 7 years. So where are we going to fall? The good news in your example is there's policies today that have joint coverage. So you're buying one policy that either the husband or the wife can tap into. That reduces risk to the insurance company that's pricing these products, and it gives you one pool that either one of you can tap into. The other trend that is developing in long-term care planning is what's called cash indemnity policies. There's two types of long-term care contracts out there. There's reimbursement contracts and there's cash indemnity contracts. A reimbursement contract, just like health insurance, if your care costs $4,512, you have to fill out paperwork, send in the receipts, and within 30 days, they're going to reimburse you $4,512. A cash indemnity contract, when you go on long-term care claim, they're just sending you a check every month. On the first day of the month, if your benefit is $6,000 a month, $6,000 is being deposited in your checking account. So if you had a situation where only one of the two individuals can buy or afford a policy, if you have a cash indemnity policy and you go on claim, you're getting that money and you can use that money to pay for care for either one of you or other bills should you need it.
That's great news. I don't have to flip a coin anymore. That's good.
Or pull out the therapy couch, because that sounds to me like you open a whole can of worms with those conversations, Michael. But so Michael alluded to the fact that it's expensive for families. Can you give us like some kind of ballpark? Like, what's it costing these days for, let's say it's a couple in their late 50s that is generally healthy?
All right. Well, there's basically 5 types of insurance policies that are out there. And for clients that are really on a budget and premium conscious, there's these policies out there called short-term care policies that are kind of like long-term care policies, but they only provide like a 1-year benefit. So if you needed care they're going to pay out a benefit for 1 year. And these policies range from $500 to $800 a year. So they're very affordable policies, but that's called short-term care. Traditional long-term care insurance is really what is the flagship solution that has been in the industry for over 40 years. And you can design a plan, a small policy or Cadillac plan. According to LIMRA, the average long-term care premium is a little over $3,000 a year per person, but you can design a plan for a smaller benefit and make the premium $150 to $200 a month. Um, the policies that provide both life insurance and long-term care are a little bit more expensive because you're getting both. With long-term care insurance, you don't know if you're going to use it, right? There's a 70% chance we're going to need long-term care, but there's a chance we might not need care. I can guarantee you if you don't need long-term care, we're all going to die. There's a 100% chance of that. So life insurance policies with a long-term care rider are guaranteed to pay you out a benefit. You're either going to get your benefit in the form of a long-term care benefit, or you're going to get that death benefit paid out to your beneficiaries. So because those policies are more valuable, they are a little bit more expensive. Um, and then the newest trend we're seeing in long-term care insurance is annuities with long-term riders. And many of your clients already own annuities. You can invest money in a non-qualified annuity. It grows tax deferred. And down the road, if you decide to pull money out, it's usually taxed at ordinary income. Today, you can have annuities with long-term care riders that now, when you go on claim, all of that growth plus leverage is going to be paid out tax-free to you. So if you have an annuity already and you transfer it into an annuity with an LTC rider, that really didn't cost you anything. You're just now repositioning an asset. And that $150,000 annuity that you owned is still a $150,000 annuity. But now if you need long-term care, it's going to pay you out $450,000 tax-free. So these types of asset-based long-term care solutions are now becoming very popular for high net worth clients because these clients are already in a situation where they're self-insuring or they're going to have to pay for their care when they need it. So let's take a look at what asset we're using to self-insure the risk and move it into a more tax efficient asset for long-term care planning.
Rick, I was going to take a break, but I want to do a follow-up question on this annuity product. So I think it's important, and I don't want to lose the track. If it's a $450,000 benefit, to my knowledge, the average long-term care claim is about 6 months, and I could be wrong, a month or two plus or minus, but you're not going to spend $450,000 in 6 months. So what happens in your example if a person does not use all of the benefit? Is there a remaining death benefit on the cash value? What happens if the original $150,000 investment, they only use a third of it?
Mhm. Yeah, that's the best part about these products is it's still your asset. So if you had an annuity with a long-term care rider and you only used a little bit of the money to pay for your care and then you pass away, the remaining cash in the account still goes to a beneficiary, just like any other annuity. But also with annuities, you can do joint ownership. So if you are married, that annuity can with an LTC rider can remain there for the spouse should they ever need long-term care services. So you continue to retain control of the asset.
And one last question: you still have to qualify from an underwriting point of view?
The best part about these products is they're much more lenient on underwriting. Because the annuity is self-insuring part of the risk, it's typically only 5 medical questions, and we have instant approval.
Oh,
Go ahead, Tracy. Then we'll take a break. Go ahead.
no. Yeah, just gonna say, whoa, that's great.
Hmm. Let's take a break on a whoa.
Yeah, exactly. We haven't done that before. We're breaking new ground, Tracy. Thank you. So on that note, whoa, let's take a break, and we'll be right back with Rick Stewart, Regional Director at Crump Insurance, with specialty in disability, limited benefits, and long-term care. All right, I'm Michael Hartzman, back with my co-host this evening, sitting in for Dominic, another one of Lebenthal's own, Tracy Burns, and our guest this evening, Rick Stewart, Regional Director at Crump Insurance, with specialties in disability, limited benefits, and long-term care. Rick, in honor of Dom, he loves using the word wonky, and he loves trying not to get wonky on these podcasts, and inevitably always does. So, in that vein, let's talk about morbidity risk and mortality risk, because they're two different things. Mortality risk is when you buy a life insurance policy. I believe morbidity risk is when you buy a long-term care policy. And if you buy a blended policy, you have to qualify for both. So a lot of clients still in their mind, say they're healthy, and then they tell me they're walking with a cane, and that's going to kibosh the whole long-term care rider thing. So can we get into that a little bit?
Yeah, absolutely. I'm happy to. So anybody that's ever applied for life insurance probably understands mortality risk. You're buying an insurance policy from an insurance company that's measuring, the risk to them on how long you're going to live. When I was in my 20s and working out and super healthy, we're all preferred best risk. And when you apply for life insurance, they ask you a lot of questions. Do you have heart disease? Do you have a history of cancer? They look at obesity. They look at diabetes, prescription medications, because they're measuring the risk that you're going to die younger in life, versus living a long, healthy life, and they price accordingly on how long you're going to live. Morbidity underwriting, or how long-term care insurance companies underwrite, is what are the odds that you are going to become ADL deficient and need help with walking around the house, getting dressed, using the bathroom. So you might have no heart disease or no health conditions, but what if you have a bad back or bad knees, or you're in physical therapy for chronic pain? These are some situations where you might be fine and, oh, I got approved preferred for life insurance, but I was declined for long-term care insurance. So long-term care underwrites that risk differently than life insurance. Back to those combination products that we were talking about, life insurance with long-term care riders will have to underwrite for both risks. They're going to look at your longevity risk and they're going to look at your morbidity risk. That's one of the reasons why annuities with LTC riders are becoming so popular today. There's no life insurance component, so they're not underwriting for the mortality risk. They only have to underwrite for a little bit of the morbidity risk. So that those products are more leniently underwritten, hence why we're seeing more sales in that department.
So if we could take a step back actually and explain the different silos, the different options that families have, right? So you had mentioned a regular straight up long-term care policy. Then we have the life insurance policy with a long-term care rider, which is basically like an attachment to it, right? And then of course we have the option to self-fund. If I'm a family, I'm sitting around my family at the holidays and I'm going to bring this up and say, Mom and Dad, who's taking care of you? How do we have this conversation? What are the different products?
Yeah, so one of the things that we always talk about with clients who are like, well, can I self-fund this risk for long-term care? And a lot of times they ask me, well, if I put this money aside and I invest it in the S&P 500 index over 25 years, I'm going to have X amount of dollars. The problem with that is, what if you need long-term care in 3 years? You don't know when you're going to have an accident, an injury, or a fall. It could be next week. It could be on Christmas Day. It could be in 3 years. It could be in 50 years. We don't know when this could happen. So that's one of the challenges with self-funding, is you might not have the time horizon you think you have to let that money grow for you. One of the advantages of asset-based long-term care is essentially you are self-insuring the risk with your own dollars, because you continue to control the money, but you're leveraging it for tax efficiency. One of the ways we look at that is with the types of products we sell, life insurance with long-term care riders or long-term care riders, there's what's called an internal rate of return. So typically, in order to self-fund, you would have to get a net after-tax rate of return of 9 or 10% to do better than these guaranteed long-term care solutions. The other thing I always talk about with clients is it doesn't have to be one or the other, Tracy. You don't have to
Mm.
completely self-fund 100% of the risk or insure 100% of the risk for long-term care. If the cost of long-term care services in your state is $120,000 a year today, why not take a look at insuring half of that risk with an insurance plan and self-funding part of that risk? That way, you're mitigating some of the risk and you have a plan in place should you need care.
So you just teed me up for my next question. It's a great segue. I'm on Long Island. Tracy's in New Jersey. We know that we're above the national average. If someone is in a nursing home, most people want to be home in their own home, no matter what their condition is. So let's talk about policy construction for a minute, Rick. The inflation rider, the daily benefit, the elimination period, all those different components that we as advisors have to advise our clients on constructing a policy. And I know it's not one size fits all, but there are common features, whether it's a 3-year benefit or a 90-day elimination period, that are used more often than others. Could we
Hmm?
just get into that for a minute?
Sure. For any long-term care solution you look at, whether it's through an employer, traditional long-term care, or linked benefit solution, there's four components you want to look at a long-term care policy. Component number one is an elimination period. So that is, when am I going to start to receive the benefits? If I fell down my steps today, am I going to start receiving benefits in 30 days, 90 days, or 180 days? So that's called the elimination period. Number two is your monthly or your daily benefit, which is how much money am I going to get every month? If I have a $6,000 a month long-term care benefit, that means I'm going to get $6,000 a month. That's number two. Question number three is your benefit period. So how long am I going to receive that benefit? 3 years, 4 years, 6 years. There's actually two carriers out there today that still offer lifetime long-term care benefits. So for the ultra high net worth clients, we do see them still buying lifetime benefits. So if you went out and wrecked your Harley and you went on claim for 30 years, those policies would pay you a monthly long-term care benefit for 30 years. They're truly lifetime. So benefit period would be the third component. And then fourth, and what's most important for younger clients, is inflation protection. As I mentioned, we're usually buying these policies when we're 50. Your average age for long-term care claim is typically 80 to 82 years of age. So you want a long-term care benefit that's going to be growing over time to try to keep up with inflation, as the costs for long-term care services continue to rise. So elimination period, monthly benefit, your benefit period, and your inflation protection. Those are the four key components of any long-term care insurance policy.
What do people miss? Like, what are some of the biggest mistakes families make when they're looking at this?
I would say the biggest mistake families make is not having a plan and not having the conversation. I've heard so many horror stories. When a long-term care event happens, as I mentioned, it's when you least expect it. Somebody
Mhm.
suddenly had a stroke, everybody's at work. What happens if you have three or four kids living in three or four different states and dad has a stroke? Nobody had a plan. Who's going to come home? Who's going to take care of dad? Does dad even have an insurance policy? If dad needs to go to a nursing home, who's going to find a nursing home for him, or if he needs home health care, who is going to take care of him? So the biggest problem we see is just families not having a plan in place, that when we need care, what's the plan and how we're going to get it. One of the biggest advantages to long-term care policies, even if you went out and you bought the smallest long-term care policy on the market, long-term care policies have a feature called care coordination built into their policies. And what that is it's a person or a phone number you can call to say, hey, I'm a policy holder, or my husband's a policy holder. He just had a stroke. He's going to need care, and I don't know what to do. A care coordinator is a third party, not employed by the insurance company, that's going to come meet with you and say, all right, if you need a nursing home, here are three in your area that have a good reputation you could go to. If you need home health care, here's three home health care providers in your area that we can get you a provider. Some long-term care contracts even provide discounts to some of these larger home health care agencies. So kind of like when you go to a vacation, you go to a hotel, and you're like, "Hey, I'm new in town. Where's the best restaurant? Where's the best golf course?" A care coordinator is going to be your go-to person in one of the worst times of your life to walk you through the process. Here's how you file a claim. Here's what you need to do. Here's where we're going to go. And they're going to help you walk through that concierge service.
A great benefit to have, um, especially when you, as you said, when you need it the most. So Rick, getting back to kind of geography, what were two questions. One, what is the average time period of once a person goes on claim that they stay on claim? And what would you say is a decent daily benefit for our clients up here in the Northeast?
Yeah, those are great questions. Again, we don't have a crystal ball. We know your average long-term care claims are 2 to 4 years. Your average claim for somebody with Alzheimer's or dementia is 7 years. You could be anywhere from not needing care to needing care for 20 years. We just don't know. So I would say the most common benefit periods being purchased are 4 and long care benefit periods. Um, Pretty common. When you look at the cost of long-term care services in the New York and New Jersey area, um, the cost for home health care services to have somebody come to your house for about 40 hours a week to provide custodial care, house cleaning, maybe getting dressed, bathing, you're going to look at spending 80 to $100,000 a year. Nursing home facilities around the clock for semi-private nursing homes can be about $150,000 a year. So we definitely see clients looking to purchase a benefit around that $80,000 a year benefit, $7,500 a month, 6,000 to 7,500 a month is where we see a lot of policies being sold. Again, that's not going to cover 100% for the cost of a full-fledged nursing home, but it's going to cover the cost to have somebody come to your house for 40 hours a week to provide home health care services.
And what does that cost then? How does that translate into dollars out today if I need $80,000 in 20 years?
It depends on the type of insurance you're buying. So if it's traditional long-term care insurance where you're looking at a premium of $3,000 to $4,000 a year per person because you're just buying the long-term care protection, life insurance policies with long-term care riders, typically you'd be buying like a $500,000 life insurance policy that has a long-term care rider. That would be depending on age. So that could be anywhere from $4,000 to $10,000 a year, depending on your age and your health. Again, because you're getting both the life insurance and the long-term care protection. And then, putting $100,000 in an annuity with an LTC rider, I don't think that costs you $100,000 because you control the $100,000. You have $100,000 in the fixed annuity. Um, if you need access to the money, you can have it. But if you go on a long-term care claim, that instantly becomes $300,000 for long-term care. So I wouldn't say there's necessarily a cost to those policies. It's just an asset reposition.
So, Rick, another misconception that people have a long-term care, or the children of people who have long-term care, is when they go on benefit. I can't tell you how many times I've gotten a phone call. We're putting mom on independent living. We're putting mom in assisted living. I need to file a claim. So there's this misconception, just because someone's going into senior living, but they're otherwise perfectly healthy, that long-term care is going to pay for it, and it's not. So could you address that?
Yeah, that's common. Just because your parents are going into independent living, or there's lots of these nice places that are being developed called continuing care
Mm-hmm.
retirement communities. Just because you move into a retirement community does not mean you're ADL deficient. Remember, long-term care insurance is designed if you need help with two of the six activities of daily living, you could receive benefits. So just because you move into a retirement community does not mean you're benefit eligible for a long-term care policy. There are communities out there, though, called continuing care retirement communities that basically take a large lump sum deposit for you to move into. And then gradually, if you ever get to the point where you become ADL deficient, where they have to assign you a nurse to take care of you, you're basically using that deposit to self-fund the cost for those long-term care services. So there are communities out there that basically you're prepaying for that future long-term care need, which again is going to be a much more expensive way to do it versus looking at a long-term care insurance plan.
And Tracy and I know about those places because we see those assets walk out the door.
On the regular. Is that inflation to have these policies inflation protected? Is that an extra cost?
Yes, absolutely. The annuities with LTC riders have a built-in interest rate because your money is growing tax deferred, so there's not a cost for that. But for traditional long-term care policies, there's policies today that allow you to buy 1, 2, 3, 4, or 5% compounding inflation. So obviously 5% is going to be more expensive than 2%. I really like a company out there called Mutual of Omaha. They have a traditional long-term care policy that lets you adjust the inflation amount every year for 20 years. It's like when I'm working in my younger years, I could buy the most expensive inflation rider. And then in 15 years, when I retire and I'm on fixed income, I can dial back the inflation, maybe drop it down to 2 or 3%. So there's policies today that actually allow you to change your benefits every year if you feel a need, you need to adjust your premium.
Rick, about once a month, I get a call from a client. They got a letter from their long-term care provider, whether it's a policy I sold them or not. Their premiums are going up, and it happens more frequently than I think we'd all like to admit. Are new policies written today to prevent that premium creep that clients are experiencing with policies they bought 15 or 20 years ago?
Yeah, that's a great point. Long-term care risk or long-term care insurance is a very new concept. It's only been around for about 50 years. So, unlike life insurance that's been around for hundreds and hundreds of years, understanding this living a long life and needing custodial care is relatively new. When long-term care insurance first came out, they really didn't know how to price it, how long we were going to live, and a lot of the original policies were underpriced. So a lot of these long-term care policies are having what's called in-force rate increases, where unfortunately they've had to increase the premiums on those original policies for traditional long-term care. Today, we now have a lot more actuarial data about life expectancy, longevity, the risk of needing care. So policies today are more expensive than they were 20 years ago, but we have a better understanding about rate stability and whether or not we're going to use these policies. Also, that is one of the reasons why more people are gravitating to the life insurance products with LTC riders or annuities with LTC riders because some of these contracts are fully guaranteed. They can't raise the premiums on you on these policies. Traditional long-term care insurance is a much cheaper long-term care solution, but like health insurance, like your car insurance, like your homeowner's insurance, it's a pool of money, and if the insurance company needs to raise premiums, they do have the ability to raise premiums on the policyholders.
I know we don't have a lot of time. These are difficult conversations for people to have with families, and I'm sure you have experience in talking to them. What are some tips that you have for people that need to approach this to mom and dad and say, "Hey, we can't afford to take care of you." How do you bring that up?
Yeah, that's a great question. And one of the reasons Long-Term Care Awareness Month is November is this is the time when it's the holiday seasons and family is getting together. It's a conversation that siblings need to have together, and they need to have an honest conversation with their parents, to say, mom and dad, what's your plan, 10, 20 years from now, if you do ever need care, where do you want to be? Who do you want to provide the care? I have 4 children myself. I have 2 children who, God willing, I don't ever want to have to take care of me. My daughter can't remember to turn the lights off, or put her clothes away. I don't want her taking care of me. I love her to death, but I want to have a plan in place that I'm not going to be a burden to my children. The parents want that. The children don't want to provide the care. The parents don't want the child to provide the care. So it's just having a slightly uncomfortable conversation, mom and dad. If something ever happened to you and you needed care, what do you think that looks like and how can we help you?
So, Rick, I think what Tracy wanted to know, does she ask that question before politics and the New York Jets? Does she squeeze that in the middle? I think that's what she really wanted to know. No,
Or do I just piss them off
Right,
and
right
ask it all
between
at once?
religion and politics.
there you go. There you go. So, look, Rick, we could go another hour, but unfortunately, we are out of time. And any folks who are listening out there, both Tracy and I are available to answer your questions. We'd always get Rick on the phone for a follow up, but unfortunately, we're out of time this evening, Rick. But we do want to thank you and thank Crump Insurance for making you available tonight.
Thanks. It was a pleasure. Always happy to do it.
And we will see you next time on a new edition of the Lebenthal Report. Have a good night, everybody.